Hello and welcome to today's webinar. This webinar is produced by the National Tooling and Machining Association and the Precision Metal Forming Association. This is the 15th webinar in this series dedicated to providing information about COVID-19 response. The presenters on today's webinar are, as always, from your DC-based advocacy team. I'm Caitlin Sickles with the Policy Resolution Group at Bracewell, and my colleague Paul Nathanson is joining me today from PRG. Also presenting are the guys from the Franklin Partnership. It's Omar Nashashibi and John Guzik, and they, as many of you know, are the on-the-ground lobbyists here in DC representing NTMA and PMA members, small and medium-sized manufacturers here in DC. The information provided in today's webinar can be found on our onevoiceinfo.org website. You'll be able to find a copy of this slide deck as well as a recording of the webinar by this afternoon. You will also receive that information by email if you're registered for today's webinar. And you can find other information that we share, the resources that John and Omar discuss, as well as a number of other pieces of information, everything from government guidance to media clips are all available at onevoiceinfo.org. All the way down at the bottom of the site, you can also find a link to our podcast where you can listen to even more from us every other week. On the weeks when we don't do this webinar, we do a podcast. It's called Talking with One Voice. You can find it wherever you listen to podcasts, and you can also find a link to it on the onevoiceinfo.org website. Before we get started with today's agenda, we're going to talk a little bit about a survey that we've recently done of NTMA and PMA members. Many of you know that we have done surveys annually, but then since the start of the COVID pandemic, we've been doing them more frequently to get information from members about what you all are experiencing, and also use that information to determine what support, resources, and tools you need from government. So here are our latest survey results. We turn them into an infographic. You can find this infographic on the One Voice Info website. You can also find it on PMA and NTMA and One Voice's social media accounts. So what are manufacturers experiencing? Well, as most of you know, nearly all of the survey respondents reported receiving a PPP loan, 91%. And of the people who received it, 90% said having received that loan made it possible to keep employees that they might otherwise have had to let go or furlough. Fully 80%, 79% said that they would seek another PPP loan if they were permitted to do so. And that's important information, obviously, for us to have and to relay to government. You will be unsurprised to hear that revenues are lower than they were pre-pandemic. 86% report that. And most people say that they're expecting it will take 6 months to a year for those revenues to return. And what does that mean? Well, it means that a lot of manufacturers are talking about potentially furloughing or letting people go if those revenues do not improve. And that, of course, is where that additional PPP or other COVID support funding might come in. So what do manufacturers need? That's our second infographic that you can, again, find on the website and on social media. These are things that Omar and John are asking Congress to consider as part of the packages that are being discussed in Congress, and they will discuss more of that. But we're talking about long-term low interest loans, talking about liability protection and general business credits and that employee retention credit. So they'll talk about all of that, and this information is available to you as well as the details that they will provide. So with that, I'm going to turn it over to John to talk about today's agenda and the many pieces of information we'll cover today.
Well, thanks, Caitlin. And you're right. The information that we received from the membership Omar and I have sent this on to Capitol Hill and the administration to make sure policymakers understand the needs and the issues important to a small and medium-sized manufacturing. So a lot has happened since our last webinar. It's going to be very busy. It's going to be a packed agenda. We're going to start off talking about some CDC guidance on the use of personal protective equipment because there's shortages out there. The Department of Labor gave some additional guidances on returning furloughed employees. The IRS has did a guidance on tax credits, we'll talk about that. Fair Labor Standards Act, OSHA. OSHA is starting up their investigations, so I want to make sure the members know about that. Then we're going to talk about the three main lending programs out there: Main Street Lending, Economic Injury Disaster Loan Program, EIDL, and of course the PPP program. We're going to talk about that in terms of the status currently and then moving forward, because that's a very important point in the next stimulus bill moving forward. And then finally, we're going to open it up to questions, but feel free to use the box on the right-hand side to type in a question during our presentation. We don't have to wait till the end of it, and we'll try to answer it as we go moving forward. So Omar, the CDC made a few announcements this week about the use of PPEs.
Yeah, they did. Thanks, John. And just we'll quickly run through a little bit here. And this may not just be for today, but also a forewarning for the fall as you get into it. We're seeing a lot of companies. I think back in April or May, we put up a couple of the tier ones out there, the Gleer and Magna, that have what they've been doing on their PPE plan and how they're dealing with rationing in case. And some of them were mandating that each of their facilities have 30-day supplies, for example. So this is just another example of how the CDC is telling people how you want to plan and how to use some of your PPP that you've developed. Well, a lot of it is obviously intended towards some of those in the healthcare settings. They're asking that this is also something that you may want to take a look at. So for example, if you are looking right now, you might be fine on PPE, but at some point in time, as we're looking at now increasingly the states requiring face masks, I think that we're up to 31, 32 states, something like that, that are requiring those now. And so if that is the case, then you may want to plan ahead knowing that you're going to have to also buy a lot of them. Things are going to start running out again. I mean, try buying a school desk for your kids at home. Those are all delayed till September because everyone's making a rush. So that's just a little bit of advice from the CDC on how to start planning and rationing if you get to that point. So this guide is a little bit more of a forewarning. Don't get to the position where you have to be rationing. We're not saying hoard it, but start planning ahead a little bit here. And lastly, on this one, before I turn it over to John to switch into OSHA, just wanted to make you all aware, since the CDC, both CDC and OSHA have translated a number of their guides that they put out in the guidance documents and the posters that you can now have in different language. I know there's some people have asked, for Vietnamese, obviously Spanish, and a few others, depends on your location. But we also put this up here because if you do have multilingual speakers or those that aren't as proficient in English as their primary, you may want to consider covering yourself for liability protection and making sure that you have all these guidance up in their language as well. So that way, if there is an incident or recordable on your property, then you've already said, look, we followed all guidelines. We put up all the posters in multiple languages. What more can we do? And so I think that's really important, especially as we get into the liability discussions that are out there. So just note that both OSHA and CDC have translated for manufacturing the different guidance documents that are out there in case you need it. But John, you hit on furlough, and that's something that a lot of people are focused on right now.
Yeah, well, the essence of the Paycheck Protection Program was to maintain jobs. We recognize, and the Department of Labor recognizes some people did have to furlough employees. And so as you bring furloughed employees back, they gave a couple scenarios, and they're frequently asked questions like, one scenario is you had an employee working with you during the pandemic, and they utilized their 2 weeks or 80 hours of paid sick leave. But then you had to furlough the employee, now they're bringing them back. So the question is, when you bring that person back, are they eligible once again for that 80 hours, 2 weeks of paid sick leave? And the Department of Labor's guidance says no. An employee's paid sick leave is limited to 80 hours. However, if the employee who has come back did not fully utilize the entire 80 hours, the employee is eligible for the balance. Conversely, in a little different way, they gave us guidance on the Emergency Family Medical Leave Act. This is a scenario where you had an employee who took 4 weeks of family medical leave during the pandemic. You then furloughed them and now bring them back. How much family medical leave is that returning employee eligible for? And here, the Department of Labor says the new employee, when they come back, is eligible for the full 10 weeks of family medical leave. Why, you ask? When the employee originally asked for family medical leave, it could have been because they had to take care of the children because school was closed. But when you bring the employee back, the reason for the family medical leave could have changed. It could have changed because, schools, they're out of school, but maybe because their summer camp was closed. And so that was their justification moving forward on why the employee gets that full 10 weeks. And they did clarify that when you look at the time off that the employee is furloughed, that time cannot be counted towards the family medical leave time. So, Omar, the IRS also gave some clarifications on the refundable tax credits regarding paid family leave, paid sick leave, and employee retention credit.
That's right, John. If you all want to dust off the cobwebs way back to early April, when we were talking to you about the CARES Act and FFCRA provisions in there related to the emergency paid sick leave and emergency FMLA that was out there, and along with the ERTC, the employee retention credit, what the government allowed for you to do, because we told them we needed cash now and cash flow was a problem, they allowed you to file Form 7200 to request an advance on some of these refundable credits that were out there. And in the language, they stated that if you overestimate your advance on it, then we'll just deal with it later. Here's the IRS guidance saying that no, they're not going to hold you at fault so long as you pay it back. But they're effectively going to say if you overestimated the amount that you requested on that Form 7200 advance to the IRS, then they're simply going to look at it as if that was an erroneous refund for which the IRS must seek repayment. So again, they're just kind of giving you a little bit of protection and saying, hey, no fault of your own. If the IRS gave you back more money than you needed, or if it was over the estimates that were there, then just go ahead and give it back to them through that process, and you're not really held legally liable. Of course, consult your attorneys and your CPAs when it comes to that issue. And before we jump into, John mentioned the OSHA and the COVID investigations, and we'll talk about it in the next slide, but this is something else that we thought would be good to send over to your HR folks. That link on the bottom right-hand side is really what you need. Fair Labor Standards Act. Under FLSA right now, there's an increasing amount of questions coming about from work at home situations. While many of you, obviously your operators are in the shop, you might still have some employees that are working from home in some capacity. So we don't have the answers on this since they're pretty long, but this is the FAQ that they just added about 6 or so questions to late last week on the 20th. So we suggest going through some of these. They'll really give you an idea of, so let's say, for example, you have an individual working from home, takes that 30-minute break to go make the kids lunch and then comes back. How do you account for that? How do they document that? What if you have an employee who was not told to do work, but hey, they got their laptop, they had an hour to kill, but decided to get some work done? How is that logged in? How are you able to deal with that? And yes, this FAQ even addresses, do you have to go and do a home inspection to make sure their home office workspace is OSHA compliant? Like my 6-year-old that trips over the printer cable that I'm looking at in my home office now. Yeah, no, you don't have to have somebody come in and do that. But this FAQ does go ahead and address that. So please take that link when you get this presentation here in the next couple hours. Just make sure somebody in your HR shop has at least taken a look at some of the answers that you'll see there in blue. But again, John, I think this is important because you just mentioned with regards to OSHA and some of the enforcements that are coming back online.
Yeah, when the pandemic first broke out, OSHA cut back on their inspections of individual facilities. They only did it in high-risk areas. But then recently they announced that they were increasing the inspections. At our webinar 2 weeks ago, we demonstrated the OSHA toolkit that they have released, that you can click on any one of 10 or 15 guidance documents that the OSHA has put together, whether it's how you're going to deal with face masks, PPEs, returning furloughed employees, et cetera. So this is just an example to demonstrate that OSHA is increasing their inspections. This is a news article where 4 New Hampshire businesses are under investigation for COVID-19 violations through OSHA. And the other important thing to note is there's no company too small. One of those companies in New Hampshire had only 49 employees. And so take seriously the OSHA recommendations, OSHA guidances, the OSHA toolkit that we provided 2 weeks ago, and make sure that you are dotting your I's and crossing your T's. Let's move into the major lending programs that are out there for our manufacturers. The first is the Main Street Lending Program. As we've mentioned in the past, not many lenders are signing up for the program. I think the last time I saw it, it was a little over 500 lenders. That's a far cry from the number of lenders participating in the PPP program. And so here on the website, you can click on your particular state, and it'll show you on the website what lenders are accepting the Main Street Lending Program moving forward. In addition, the Main Street Lending Program was set to expire at the end of September, and then they did announce that they have extended the deadline till the end of the year moving forward. The Economic Injury Disaster Loan Program, EIDL, this is a loan program that you can get approximately $150,000 loan through the Small Business Administration. As part of this program, they used to have basically a no questions asked grant program. Well, that grant program has run out of money, but they've already loaned out roughly $150 million. So that is an option there for you. And then finally, just an update on the PPP program. Manufacturing is maintaining its role as one of the top 4 recipients of PPP funding. You can see there are fewer manufacturers compared to some of the other major industries out there, but we're getting a larger share of the dollars moving forward, and we're maintaining at 10%. Finally, for those, I mean, as Caitlin mentioned earlier, that 91% of our members have already received PPP money, but if anybody hasn't, there's still roughly $130 billion still left in the program. So, go ahead, Omar.
Yeah, as we jump in, I think it's important. Well, John's going to come back in a bit, and we'll talk more about what's happening next with the 3P program along the lines of Caitlin's numbers that say a good number of our folks would want another round at PPP. But let's just spend a couple of quick slides, if we could, on forgiveness. And for the forgiveness of the loan, what we're going to look at in the next 3 or 4 slides are, as of right now, Congress is clearly making changes that we're going to review, and those will definitely make alterations to not just the forms itself, but also what is included. So we'll talk about what they are proposing up on Capitol Hill, but these next 4 slides are for the lenders. So what we try to do is not just follow what impacts you all as the borrowers, but we also try to read through and what direction that the government's giving to the lenders. That's what these next 4 slides are right here, and they tell you how they're going to review the loan. So especially for those of you over $2 million loans, when they talked about the automatic audit triggers, here's what they're telling the lenders that they want when they're going to review a loan. And frankly, it's not a whole lot different than what you all already submitted at the onset of this entire process. So we're not really overly concerned at this point with the way this guidance is written on top of the way that we're looking at review of these loans. However, obviously the lender is probably going to add some additional requirement, want to actually seek some documentation to verify the attestation that you've complied with all the provisions there. So just a heads up that they are working through this. We're getting a little bit closer on some of these things. And this is the guidance that was just issued to the lenders last Thursday, I believe it was. And this is important. I mean, John's got a relative that works in the banking industry, and she's verified this as well, our expectations. But the government did announce last week that the official portal for submitting a forgiveness application will be open on August 10th. Now, what that means is, as of right now, you are all free to go ahead and submit your request for forgiveness, your application to your lender. However, the lender didn't have anywhere to submit that application in turn. So now they're telling us that they've contracted with another group, they're going to be up and running, and they're going to open it up for the lenders to submit an application for forgiveness in the portal on August 10th. Now, we're going to talk about why we don't think that's going to happen, in large part because of the changes Congress is going to make. So they're very direct in the guidance that they put out, saying that this is all subject to additional congressional changes. But just to let you know that at least this tells us they are far enough in the process where if there are changes to Congress, then at least they've got the portal and they've got a method by which to go. And then reiterating the Mnuchin comments below there in red, you'll see that you're permitted to submit your forgiveness application prior to that 24-week period ending. And we understand that creates some complications with the 25% reduction on your wages paid. But again, when John gets into some of the details here, and we do later, you're going to see that's going to get changed by Congress. So again, this isn't really much to follow through. That just tells you the different answers you will get when you are going in for forgiveness. So the lender pretty much has to say, we're going to ask for forgiveness in full, in part, denied, or denied with prejudice. So that's really the categories. But lastly, on forgiveness, before I turn it over to John to talk about the next steps in the mess that is the U.S. Senate right now. This is just at least I won't put John into this mess. This is just my personal advice on how to look at changes on forgiveness. Be patient. You really do need to be patient. We understand you want answers, you want to submit it, but right now is not the time to rush to submit your application for forgiveness. Knowing that there's going to be some more time, there's going to be some flexibility that's going to be made through Congress that we'll talk about here. So if you are over 2 million, yes, probably fill out the application that's already out there for forgiveness, as much of that documentation is still going to be required of you. However, if you are between 150,000 and 2 million, as most of our members are, you're not going to need to fill out and provide all that additional information in the first round. So a lot of it is talk to your lender and sit tight for a little bit. They are going to simplify the forgiveness process. And yes, they're going to keep making changes on you. We understand you want one set of rules by which so you can just go ahead and operate, but no, not in this environment. Keep expecting more changes. And then lastly, on timing, we mentioned the August 10th date. We do expect that to slip. Keep in mind that let's say Trump signs a bill on August 14th. then the Small Business Administration and Treasury will have about 30 days to submit guidance and regulations to implement the new changes. So even if we do get something done here in the next couple of weeks, it still might take 2 to 4 to 5 weeks before the Small Business Administration and Treasury issue their interim final rules. So again, you're not going to have everything up and running most likely on August 10th. And a large part of that, John, is dysfunction over in the U.S. Senate with McConnell and company.
Yeah, I don't know. Many of you saw Senator Lindsey Graham's comments on the Sunday morning news shows, where he made the prophetic announcement that half of the Republicans in the United States Senate would not support this next stimulus bill moving forward. That cuts the legs out under Mitch McConnell, the Senate Majority Leader, in his negotiation, and only enhances the negotiating position of Pelosi and Schumer moving forward, keeping in mind that McConnell needs to get 60 votes. And so when half of his when Graham says half of his conference may not support it, Pelosi and Schumer knows that McConnell needs to negotiate with the Senate Democrats, and that's exactly what is happening. The Republicans in the Senate are in a very difficult position. Last week, I think it was Chief of Staff Mark Meadows offered, with the expiration of the enhanced unemployment benefits, well, let's just do a smaller standalone bill and do that, and then we'll work on the larger stimulus bill later on. Well, that was immediately rejected by Pelosi and Schumer, because they know if there's this standalone bill just dealing with unemployment, maybe liability, a couple other cats and dogs, there's very little impetus to move a larger piece of legislation. And so that has been the challenges moving forward. So what are some of the sticking points out there besides unemployment insurance? Just yesterday, for those of you who watch the news, they did talk about Meadows and Mnuchin did offer a extension of the unemployment benefits, the enhanced unemployment benefits, at the current $600 a week rate for 4 months, which basically takes them to the end of the year. And again, because of the weak negotiating position, Schumer and Pelosi said, nope, we want it till the end of the first quarter. And so those are where the lines are drawn there. Other sticking point is school funding. 3 weeks ago, when the House Democrats put their the stimulus bill together, they asked for $100 billion for schools to purchase the necessary PPE equipment. Well, 3 weeks later, the number is now $400 billion. So that's a point of contention. State and local funding that we've talked about in the past, the McConnell bill, which we'll talk about in a little bit, did not include any additional funding for state and local funding, and so that's a concern. And then the liability protection reform, Speaker Pelosi has real concerns about liability protection reform for business. But the big overriding issue of why 50% of the Republicans in the Senate are supportive of this moving forward is a good number of them wake up every morning and think they can do a better job of being president, i.e. Ted Cruz. So there's a number of folks in the United States Senate who are not very optimistic of President Trump's reelection, and perhaps are they setting themselves in setting their position on government spending as they look towards a next presidential election. So, Omar, that's some of the bad news. Why don't you tell us some of the good news where there is some areas of agreement?
Yeah, I think that's a really good analysis of it, because especially, believe it or not, we are all looking at 2024, and that's why now I'm starting to think Kamala Harris will not be the VP, because everyone is looking at, you can't just anoint her, and now you've got all these folks in Cruz. Ted Cruz hasn't cared about the budget deficit for 3.5 years. Why does he care now? Because they believe the president is weak and not going to win. And in looking at that, that is now shaping the politics of that, and the election, this one and the next, is what's shaping this bill quite a bit. And so we do have some areas of compromise, but as John mentioned, there's still quite a few areas. They're not even close, folks, on this, and we'll talk about timing in a minute. But one of the few areas where there is some good news, employee retention credit, there definitely seems to be that will be in a bill to be expanded. They will alter it to allow those who received a PPP loan that is forgiven to also be able to claim the employee retention credit. What you see here, this is not law, but this is what the Senate Republicans are proposing. The House Democrats are a bit more generous on the ERTC, providing what amounts to about $36,000 worth of refundable tax credits for any employee that's being retained. What the Republicans do in the Senate is basically $10,000 per quarter for Q2 through 4, or $30,000 for the calendar year here that you've got remaining per employee. The other important thing that they've done here is that there was a gross receipts test, and we're going to talk about the needs test, the loss test here, that we are not big fans of. So at least they took this one down from 50% to 25%. And if you look at our survey results, it showed that we had about 13%, I think, of our members have 50% revenue drop or more over pre-COVID levels, whereas we have about 37% of our members have 25 to 50% revenue drop. So we believe that the 25% or more threshold does address that concern for a number of our members, along with some other changes that were there. I think John and I also think, speaking of elections, that McConnell needs to take care of Susan Collins and a Maine Republican up there, and her top priority is PPE protections. And so we're likely to see some kind of a tax credits there, and even expansion of the PPP loan itself use to be for those for workplace safety and kind of things like that. So that goes back to our comment on rationing. With all of these different government incentives and funding to buy additional PPE, we do believe, and we are speculating, that we're going to see some other issues that come down the line out there. So that's something that's out there. But John, what do you think about the $1,200 payments to individuals? Do you think that's going to end up being in there?
Yeah, I do. I think there's general consensus of the $1,200 in the Senate package. They lifted the cap. In the past, it was the children were receiving $500 if you were under 18. Well, in the McConnell's package, if you have a child who you claim as a deduction, regardless of age, they would be eligible for that. And so while the House Democrats were looking at a little larger number beyond the $1,200, I think, again, sort of similar to the EITC, where the employee retention credit, where you had House and Senate both had changes to it. The House was more generous than the Senate. The same thing moving forward on the direct payments to individuals. So I do think this will be included in the future package.
Yeah, I think you're right. And you mentioned the word deduction. Speaking of deduction, one thing that our members are really anxious about is the IRS Notice 2020-32 that disallowed or clarified that no, the IRS is not letting you to deduct as expenses the wages, rent, utilities if your PPP loan is forgiven, which is definitely in contrary to the intent of what Congress had in mind for that program. Now, the IRS and the accountants all say, hey, you're double dipping. And personally, yeah, I do agree with that interpretation. You are double dipping, but that is not what Congress wanted. And therefore, we think the IRS is erroneous in their interpretation of this specific provision. There is an effort right now to override it to allow you to deduct those expenses under PPP, even if it's forgiven. And that is a pretty significant hit. If they were to disallow it, that could mean about up to 37% hit for you pass-throughs and 20% for you C-Corps in terms of what that PPP loan meant to you. So that's something we're lobbying to change. We're getting a lot of opposition from it. John heard back from a contact at Treasury Department last week that also was questioning where we're coming from on wanting to get that overturned. But right now, it seems like it's only Treasury that's pushing for this thing to stay the way it is. We do have strong allies up on Capitol Hill. Apparently what happened was last Thursday, McConnell had this provision to take care of the expensing deduction in his underlying bill. On Saturday, Mnuchin said, no, we're not going to start negotiations with it in it. And so that's why many of us are calling this bill that you saw floated on Monday the appeasement bill, because it's just trying to appease a bunch of different parties that are out there. So in the end, we think this gets added back in. But McConnell staff, she told us that in order just to get to point one with Mnuchin, they had to get that one out. So don't fret too much if you haven't seen it in there. We still are pretty confident from sources out there that it will happen eventually. But there are, John, some other changes that they've done to the PPP program, and I think again go back to the level of support that it's gotten from our membership, as you can see in the surveys.
Yeah, absolutely. Strong support within the surveys, strong support within Congress. In discussions yesterday with Mnuchin, Meadows, Pelosi, and Schumer, the PPP program was one area of consensus, and so that is one area of consensus that's very important to us. There will be changes to the PPP program, though. Chairman Marco Rubio, chairman of the Small Business Committee, is working with Senate Democrats on enhancing the bill. So there's going to be tweaking of the current program, and then he's going to create a second PPP program. So let's talk about the changes in the current program. You're going to see the elimination of the 24-week loan period. Remember there, you had the choice of 8 or 24 weeks. It's going to be changed to 8 weeks or December 31st moving forward. Insurance benefits will be able to be claimed as payroll costs. In addition, they're going to give you more flexibility in how you can spend the PPP money. For example, for software, human resources, accounting, you'd be able to use your PPP for PPE. That's confusing. So you can use some of the money to purchase that. And then really, this is a very important clarification. Many of you have signed contracts prior to February 1. For example, your steel and aluminum contracts. Well, you'll be able to, under the program that has been outlined, you will be able to use your PPP money for a contract that you engaged in prior to February 1. For example, your steel and aluminum.
Right, exactly. So what the committee is saying on this, committee staff that we spoke with last week, we asked them specifically about this provision. We said, here's our scenario. So let's say we have a contract to buy $500,000 worth of steel prior to February 15th, which is the trigger date. Can we use PPP funds to spend on that $500,000 for my steel order if it was under contract prior to February 15th? The answer we got back from staff was yes, that meets squarely within the intent that we have. Again, if you had it under contract prior to February 15th. So that's the key that you've got to take a look at. Now, the thing that we really caution you to watch out for is now that you can include raw materials and other supplies, you could really run afoul of the 60-40 forgiveness threshold very, very quickly. And so you're going to want to be very cautious that you're not exceeding the maximum 40% allowable on non-payroll costs, such as these. So that's something you're going to want to track pretty closely. But if this does go through, John, yes, you're right. That is something that's pretty significant up there. Sorry.
And then the second PPP program that is being discussed is this would be for those who've already received a PPP loan, they could reapply for a second loan. So that's very positive. The problem is there's going to be some severe limitations. You have to be under 300 employees. And then there's this 50% revenue loss, as Omar's mentioned in the past. We don't like the 50% revenue loss. We'd like to get it lower than that. And it would be based on your revenues from Q1 or Q2 of this year compared to last year. And then it does cap, which I don't think it's going to have impact many PMA or NTMA members, but there is a cap of $10 million. That's the most that you can receive from any SBA lending program moving forward. And again, as we mentioned earlier, you're able to use your PPP. By receiving the PPP, you can also continue to utilize the employee retention tax credit moving forward. So other lending programs. So one of the issues that we saw in the survey is our manufacturers are concerned about the access to capital. And so Marco Rubio and the Senate Small Business Committee are looking at establishing a low interest loan program, a 20-year loan program at 1% interest rate. Of course, there would be some certain limitations to it. It would have to be a certain number of employees that you have. Only the smaller companies would be eligible. The loans would be available for hard-hit communities, poor areas, and so there will be limitations on that. But again, it's addressing the concerns that manufacturers have that they are not going to have the capital moving forward as the economy moves forward. A couple additional things: principal interests are delayed for 2 years and such. And so this is a program that's still in discussions, but hasn't been finalized because, as we mentioned earlier, remember the budget hawks in the Senate. Many of them are not crazy about this program, and this program is basically an enhancement of the Small Business Administration 7A program. They are concerned that this new lending program, it just blows the budget, just more government spending. So that is a drawback moving forward. But because we're hearing, from our constituents that this is an important program that we want to continue working and massaging in these negotiations.
Yeah, so a little bit more details on that 7A and what their intent and what they're trying to do. As John mentioned, this has already been there. It's a 7A program. It's been around for a while. They are hearing quite a bit that the PPP has been good for payroll, but our argument is we need access to capital for purchasing raw material and equipment, especially as things ramp up here. The conversation that we had with the staffer last week when we asked them about the steel issues, basically the way they're telling us is that they want PPP loans to be done for everything before February 15th, and then they want to transition you either to MSLF or a 7A or some other type of credit facility program to move forward in your additional operating expenses moving forward. So that's the concept that they've got behind it. What they had last week, the language did include NAICS 31 to 33, which is all of manufacturing. That was a specific carve out that was included. Then to John's point, there were concerns about how big this program would get in terms of the price tag. So we got knocked out of it over on Monday. I think we got kicked out of it after negotiations. So now there's two parts of efforts here. We think we can get some flexibility on the locations. As they mentioned, you have to be in a census tract of low income and also service of people that are in that get your primary income from that low income service tract. We think we can get them more flexible on that. There is a letter writing campaign. The staff has specifically asked us to put stuff in writing to Senators Rubio and Cardin. So we've got draft NTMA and PMA letters that's going out today or tomorrow this weekend on that to help them out to make those changes. Because right now, the lobbyists over at NAM, what they're pushing for is to use the Federal Reserve and have them set up some kind of a short-term facility. Our concern is take a look at MSLF that took 4 months just to get it up and running. To John's point, not even 500 lenders in it. So we're not as crazy about the Fed running it. We're wondering if we can just take and make changes to that 7A, since that would operate a whole lot more quickly. But yes, we definitely need to get rid of that geographic tract issue on the low income, and then also lower the 50% lost revenue. We think we can get that down to 25%. So they're asking us for feedback. We're actively talking to them about how to do that. And you're asking, okay, why would a bank participate in this with a 1% loan interest rate? What they're doing is it's SOFR plus 30 basis points is how they're going to bring the banks into it. And you cover 1% and the SBA will cover the difference. And that's how they're trying to get the lenders in there. We do have credit elsewhere waived, but we do not have the personal guarantee waived. But again, if you have 100% SBA guarantee, we're hoping that that's going to address that issue somewhere along the line. And then just a couple of things here on the timing of it before we turn it over to Paul and Bracewell here on the next slide. Again, be patient. This is important. I think John mentioned that they're struggling with the negotiations. Let's be honest, negotiations haven't even really started because the Republicans don't know what they want. It's been kind of a mess over there between the White House, and Mnuchin got handcuffed with Meadows walking around the halls with him, so he can't make a deal as quickly. So unemployment insurance, yes, it's running out today. Federal eviction moratorium expired last Friday. To John's point, Pelosi knows she's got a winning political hand, and why would she give it up and bail out Trump and McConnell right now, 94 days ahead of the election? So I don't see that happening right now. John, what's your gut tell you right now? I do think that we do get something over to the president probably around August 14th, because you do have the Democrat convention coming up on the 17th. But at the same time, it's just going to take one Mike Lee or one Rand Paul or one Ted Cruz to derail this thing even further over in the Senate, and he needs Schumer more than ever.
Yeah, I think the most important date on that slide is the Democrat National Convention on August 17th. And I agree with Omar. It may be the 14th, it may be the 15th, it may be the 16th, but it certainly won't be the 17th, because you can just imagine all the Democrat speakers at the Democrat convention just ripping on Republicans for not agreeing to this larger stimulus package moving forward. So I think there's going to be probably a week to 10 days of, saber rattling on both sides of the aisle, and then as we get close, probably that. The week of August 10th, they're going to be start with some serious negotiations moving forward, so they get a resolution. Congress is not going to leave until this is done. They may, they may leave town at the beginning of August, but I know they will come back to vote on this, because this is so politically important moving forward, not only for House and Senate Republicans who are up for re-election, but also the president, which, as we've mentioned before, Pelosi and Schumer have the edge there, and while the president may want certain things moving forward, he needs a additional stimulus package. He needs those individual payments, direct payments to taxpayers, so as a boost for his reelection.
Yeah, there's no question that's what's driving this. He needs money there, especially as he's doing whatever convention style that he's doing. As to the $600 that we hear a couple of you comment on from time to time, that $600, they will get another round of unemployment insurance. There's no question. There's over 30 million Americans that are currently getting this. And so the question is, how much is it going to be? It's not going to be $200. It's not going to be a formula based on previous wages, because the state unemployment agencies have said that's just not feasible. And so most likely, my gut tells me you're in the $350 to $450 range, somewhere like that. Think back to Andrew Yang and his $1,000 a month kind of thing. I think that's probably where they end up, and trying to get folks somewhere in that range, and just try to get them by there and there. But Paul, why don't we just talk a little bit about what you're all seeing on the media side and some of the activities that you all have done there?
Yeah, obviously there is a lot of interest in what's going to be in the bill, and what we've been doing to support Omar and John is to put out the numbers from our survey. We put out this press release that did receive some pickup in some trades, as well as on social media, and continues. Yeah, actually today I saw a couple tweets from some manufacturing trades that were quoting our survey. So we will continue to engage with the media to make them aware of what the priorities are for NTMA and PMA members in the bill. One results that when we do this, when we build up a presence in the media, it results in media calls on all sorts of things. So I do have one request for those who are on the webinar today. We did get a request from the Wall Street Journal. If you go to the next slide, the request is to talk to manufacturers who have benefited from the regulatory reform implemented by the Trump administration. If there's a particular permit or a policy change that has happened over the last 3 years because of the regulatory reform effort, the Wall Street Journal would like to hear from you. They're doing a series of stories leading up to the election on what's been going on regarding manufacturing policies, what has helped manufacturers. And so if you could just, my email is up there. And if you can send me an email today, it's not a tight deadline, but the reporter is lining up his interviews to occur over the next week. And as always, as Caitlin mentioned at the beginning, we'll have a new podcast up next week. Obviously, it's a critical week in the Senate and the House regarding the COVID legislation that Omar and John have been talking about during this webinar. So please give us a listen. We'll also talk about some politics, and you can get the podcast wherever you grab your podcast: Apple, Google, Spotify, Stitcher, SoundCloud.
And as always, please feel free to support in any way you can your associations. I know you're all doing tough times. They are as well. That's how these resources are coming to you every other Friday. And I think this is number 15 or so that we've done of these webinars. I hope you found them helpful at a time like this. This is really the front lines in Washington. We're trying to give you as much direct information as possible. Here's some links. Please do so. Please contribute. You can see those links down here again as we try to take a couple of questions. As always, the question box over on your right. Please go ahead and type in whatever you've got there. If not, you'd like to ask more privately, please feel free to email one of the four of us or contact NTMA and PMA locally, and we'll address that as well offline. Again, sorry we've run a little bit long, but as John mentioned, we've got a lot going on between the Hill and the regulators. 3 quick questions here. Can you apply 100% of the PPP funds to your payroll, or must it be spread out to include rent, utilities, etc., to qualify for forgiveness? So to answer it in the inverse, the way that they look at this is they say you can spend no more than 40% on eligible non-payroll costs. So it does not set a floor for the non-payroll costs. It sets it for the it sets a ceiling for the non-payroll costs. It sets a floor for payroll costs as they are defined, and that floor is 60%. So if you choose to do 100% on payroll, honestly, I think they'd love you for it. That's even more so what they wanted and what they intended. So yes, our answer is, from what we understand, is yes, you can use 100% on eligible payroll costs, but you may use no more than 40% on eligible non-payroll costs. I'd like to just jump down to the second PPP program. The way they're going to be referring to this, at least what Hill staff are, is PPP 1, which is the initial one, and what we call second draw. Any changes that John outlined that are being made to PPP 1 are also being made to second draw unless they specifically state otherwise. So for example, the 300 employee limit and the 50% reduction applies to second draw, but not PPP 1. PPP 1 language that we discussed with regards to the new eligible non-payroll costs, such as suppliers and the other items in software that John mentioned, those are also applicable to the second draw. So the way you want to read second draw, if and when it does come about, is anything and all the rules you had under PPP 1 are retroactive and also apply to second draw unless there's something that specifically states otherwise. That's at least what Small Business Majority staff said last week, or earlier this week rather, and so that's what we're moving forward with. So again, anything you see that's being changed on the first one and you have already, let's say, spent down all of your loan after 13 weeks, yes, these changes being made do apply to you. So that's why you're going to want to talk to your lender and your accountant, because the other provision that is pending in this legislation states that you can also go back to your lender and ask for even more money under the PPP original loan, so long as you look at the reasoning behind it and it says, yeah, you've got a new reason out there for it because of the expansion that Congress allowed. So if you got new uses that say, hey, I want more money, but again, the 2.5% is still sitting there against. Another question that we've got with regards to that revenue needs test and how is that being calculated? So calculating the 50%, whether it stays at 50% or gets down to 25, as John and I would like to see. Here's how the language is. They compare Q1 or Q2 of 2020 to 2019. So let's say most of you, what you would probably do is you would take your Q2 revenues from 2020, you compare those to Q2 19 and calculate your 50% or more revenue loss as such, using those equal quarters over 2019. So again, talking to some of our manufacturers, you're definitely over the 25. We have heard some of you that yes, you are hitting that. If you use Q2, then yes, you probably are able to get to that 50% threshold. We have not heard that they're going to get to Q3. We're definitely not there yet in terms of legislating, and John may have thoughts on what we do in lame duck, but right now you're just looking at Q1, Q2. Last question here, then we're running a bit long, and this one I can speculate, may not have a solid answer on you. Would the raw material purchases for a manufacturer be applicable to the distributor purchasing their inventory? So under the new PPP, where they're saying that you can use supplier costs, the question is essentially, if I am a distributor and I'm bringing the supplies in and I'm a service center shipping them out, how will that apply? Yeah, we'll ask staff if they mean for that to be supply, because they use the word supply, not the word inventory. And so I think the congressional intent, and this is speculation, John, others jump in, but the speculation is they believe that this is an input that you need to run and operate at your business, whether it's food or otherwise. Now, I get it, if you're a service center and if you're not doing cutting and you're bringing it in, I don't know how they'll interpret that. We will ask them this weekend and see what they've got to say. But the intent, the language just says supply at this point in the language, but Paul, maybe some of your legal team over there on your side of Bracewell, we can pass it to them, see what they think as well. With that, we don't see any other questions in there. Any other things that you all need, please feel free to reach out to us. Thank you as everyone for your support and following us every other week, and your donations. Please do donate to NTMA and PMA so we can continue doing this for you. We will have another webinar 2 weeks from today, it sounds like. I think we were hoping this would be our last, folks, with Congress finishing it up, but they will not. John, do you think when we reconvene at 12 o'clock on August 14th, we're going to have a bill?
No.
Right.
So, yeah, we'll have another webinar in 2 weeks, and we'll be able to get more details, but we won't have a final package. We'll probably get it that evening or on Saturday.
All right. Well, on that sour note, and in the note that even more of my baseball watching right now is getting canceled with the Cardinals coming up sick, we'll talk to you in about 2 weeks from today. Thanks, everyone, for joining.
Thank you.